Property is also one of the few investments that you can make with limited or no capital at all. If you can secure a 100% bond from a bank, you can own an expensive investment without having to put down any of your own money. The words saving and investing are often used interchangeably, but they are definitely not the same, and it's important to understand the difference. Simply put, saving is the accumulation of money. For many of us, we save by accumulating cash in a bank account. Others save by accumulating physical cash under their mattress. Saving is typically understood to be a low-risk endeavor, where our money is easily accessible when we need it, and the risk of losing money is minimal. Saving cash in your local currency, such as the dollar or euro, is the most common way that people save today. But it's by no means the only way to save, nor is it the best way to save. We'll come back to this point a little later. Investing, on the other hand, is a high-risk endeavor, where the risk of loss is greater than the money held in a savings account, but the potential returns are also higher. There are many different types of investments, and generally speaking, once invested, your money may not be as easily accessible as cash in a savings account. Investing should therefore be understood as being a long-term commitment, say 5 to 10 years. Before we discuss some of the different investment categories available today, it's important to understand the reason why investing is important.
Now, on the one hand, the answer is obvious. We invest to increase our wealth and make more money. Investing enables us to make more money through the use of leverage. We're creating an opportunity for our money to work for us, in addition to the money we receive from our job each month. And this accelerates the wealth creation process. But there's an important underlying factor which really highlights the need for having a solid investment strategy, and that factor is inflation. Inflation is not well understood by most beginner investors, but we'll break it down for you. Inflation refers to rising prices, in other words, the increase of prices of goods and services in an economy. As the general price level rises, each unit of your currency buys fewer and fewer goods and services. And we've all experienced this to some degree, whether it be the price of your groceries going up each month, your landlord increasing your rent, or the now exorbitant cost of drinks at your local bar. This is inflation. But we need to go a step further.
Whilst inflation makes it appear that prices are rising, it's in fact more accurate to say that the value of your currency is declining. So in reality, inflation decreases the purchasing power of your cash. In other words, you can buy less and less for the same amount of cash. Whilst you may be able to exchange that $10 bill in your pocket for a lunch meal today, in a few years' time you'll be lucky if you can still buy a coffee with it. So now that we understand inflation better, let's get back to the original question. Why is investing important? Well, as you may have figured out already, investing our money allows us to fight back against the negative effect of inflation. In order to retain the value or the purchasing power of our money, we must invest. Saving is simply not enough. No saving account in the world pays interest at a rate which keeps pace with inflation in the long run. So if you are storing all your money in a bank account, you're essentially getting poor slowly. Inflation is steadily eating away at the value of your money.
To properly account for the impact of inflation on our money, we need to understand the difference between a nominal return and a real return. A nominal return is simply the expected return of an investment before taking inflation into account. If your bank advertises a savings account that pays you 1% interest, they're advertising a 1% nominal return. If you expect to get 6% per annum on your stock portfolio, you're probably thinking in nominal terms. In fact, most of us only ever think about nominal terms. But we need to start thinking in real terms. Real returns are the returns that you expect once you have accounted for inflation. As the name suggests, real returns are just that. They are real. The only accurate, true way of measuring an investment is by focusing on its real return. If we're not considering the impact of inflation on our money, we are not considering reality, and we thus won't be in a position to make properly informed investment decisions.
Let's now take a look at some of the investment options available today. The first investment is stocks. Stocks are also referred to as shares or equities. When you buy stock, you're buying a piece of a publicly traded company. Most very large corporations are publicly traded. Corporations like Tesla, Apple, or Facebook. If you buy some Apple shares, you become an Apple shareholder. You essentially own a tiny fraction of the company. So how do you make money? Well, when Apple's share price goes up, the value of your investment goes up. In other words, you receive growth on the capital you invested. So if you sell your shares in future, you'll receive a profit on your initial investment. The other way to make money with stocks is through dividend yield. Many companies pay their investors a share of their profits on a regular basis, and these payments are called dividends. You can usually choose whether you want the dividends to be paid out to you in cash, or if you want the dividends to be reinvested in the company.
The second investment option is bonds. Bonds are issued by governments and companies when they want to raise money. So when you buy a bond, you are essentially lending money to one of these entities. In return, the issuer agrees to pay back your capital after a set amount of time, as well as pay you interest along the way. The benefit of bonds is that they provide a steady stream of income, and generally speaking, they're a lower risk investment than stocks, for example, which can be quite volatile at times. But whilst bonds have traditionally been considered very safe investments, there is still significant risk, especially in today's economic landscape. And considering that the rate of return on bonds is typically lower than it is for stocks, investors must carefully weigh up whether the risks are worth the reward.
The third investment category is exchange-traded funds, or ETFs. An exchange-traded fund is an investment product that tracks the performance of an index, such as the S&P 500 index, for example. Basically, instead of owning just a single stock, you own a basket of shares in a particular segment of the market of your choosing. If you want to be invested in the tech segment, there's an ETF for you. If you prefer to be invested in a geographically different sector, like say Japan, there's an ETF that does just that. An ETF is bought and sold on the stock market like a regular stock, but because you have exposure to a broader segment of the market, it means that your investment is more diversified than just owning any single stock. Most ETFs don't require much capital to get started, and in general, the fees charged are very low. Because of this, ETFs have become a very popular method of investing, and it's a great investment for beginners.
The fourth type of investment is a mutual fund. A mutual fund, also known as a unit trust, is quite similar to an ETF for practical purposes. The major difference is that a mutual fund is generally run by a fund manager who tries to put together a portfolio which beats the average returns that the market produces. The downside with a mutual fund, however, is that the annual fees are usually much higher than an ETF, and additionally there's usually a much higher minimum investment amount. And this may disqualify some beginner investors.
The fifth type of investment is property. Property as an asset class is very versatile, allowing investors a great number of different options to pursue. You can buy residential property like houses or apartments. You can buy commercial property like offices or retail stores. Or you can focus on industrial properties such as warehousing or storage facilities. Many investors prefer property over other investment classes because of how much direct control they have. For example, you can buy a house and convert the garage into an extra room to let. Or you can renovate an apartment and charge 20% higher rent. Property is also one of the few investments that you can make with limited or no capital at all. If you can secure a 100% bond from a bank, you can own an expensive investment without having to put down any of your own money. This means that you can employ financial leverage in order to receive a far higher potential return on investment. With property investing, you make money when the value of the property increases, and you also receive monthly rental income. Although property is an extremely versatile and potentially profitable investment, it does require a much more hands-on approach, and there are some risks which make it less suitable for a complete novice investor. That said, if you're willing to put in the time, both to educate yourself and to actively get involved, property investing can be very lucrative.
The sixth investment option is a real estate investment trust, or REIT for short. A REIT is a company that owns, operates, or finances income-producing properties. REITs generally own many types of real estate, including office and apartment buildings, hotels, shopping centers, warehouses, hospitals, and more. Most REITs are public companies which you can buy and sell on the stock market, just like ordinary stocks. They are a great way to get exposure to the commercial property market, without having to own a physical property. And many investors in fact prefer REITs to physical real estate investing due to REITs offering a passive, more diversified means of investing in real estate. REITs are also much more liquid than traditional real estate, which basically means that they are much easier to buy and sell. So how do you make money with REITs? Well, like ordinary shares, you have the opportunity of both capital appreciation and an income stream. REITs generally tend to generate a steady stream of income, and often at favorable rates, but it should be noted that capital appreciation can be slow.
Now, what about retirement plans? Well, retirement plans aren't actually a separate category of investment. They just give you the ability to buy different categories of investments, such as stocks, bonds, and funds in tax-advantaged ways. In addition to tax advantages, some employers offer to match their employees' retirement contributions, which does make investing in retirement plans an attractive option. The downside, however, is that in most cases your money remains locked up and completely out of your control until retirement age. Some might say this is a good thing because it helps to avoid any temptation to spend the funds. But we are never comfortable handing complete control over our money to someone else. A lot can change over the course of 2 or 3 decades, including the types of investments available or the government policies and regulations. This is why, at a minimum, we always advocate that investors accumulate money outside of their pension funds too. In part 2 of our investing series, we cover a few more asset classes you can invest in, one of which is our personal favorite. So be sure to check out part 2 after this video. We'll leave a link in the description below. Now that we have an overview of some of the common investment options available today, let's discuss a few investing principles which may help to narrow down the choices.
Diversification, or not putting all your eggs in one basket, is a basic investment principle most of us have heard of, and it's a strategy which can work well for beginners. It makes sense that spreading your money across various investments can reduce risk. Since any single investment only makes up a small percentage of your portfolio, if one investment underperforms, your overall portfolio is not affected too badly. A properly diversified portfolio might split investments across multiple asset classes in different economic sectors, different geographic locations, and may even be denominated in different currencies. But we'd like to issue a word of caution here. It's absolutely possible to over-diversify. And whilst it is a good investment principle in general, diversification should not be seen as the be-all and end-all of investing. Many serious investors consider over-diversification to be a form of intellectual laziness. It's tempting for new investors to take a shotgun approach to investing, rather than taking the time to properly understand what they are committing their hard-earned money to. This approach is probably closer to gambling than it is to investing, and it can result in underperformance and financial loss. Now, obviously, we cannot speak to what the right amount of diversification may be for you, but you should never diversify simply for the sake of doing so. Always understand what you're investing in and make informed investment decisions.
At the beginning of your investment journey, you may find it difficult to achieve a level of diversification that you are comfortable with. It can be difficult to diversify if you have a limited budget and you're trying to buy individual stocks, for example. With $1,000, you'd only be able to buy stocks in a handful of different companies. And of course, this is just as risky, if not more so, than being over-diversified. This is where something like an ETF is helpful. It allows you to own a well-diversified portfolio of stocks from day one, which makes this an ideal investment type for beginners.
Albert Einstein once said, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." We'd like to demonstrate the incredible power of compound growth with 2 quick practical examples. Example 1. Jack saves $250 per month from age 30 right through until age 65. That means Jack has saved for a total period of 35 years. Assuming a 9% return per year, Jack will have accumulated $740,000 over the 35-year period.
Example 2. Beth saves the same $250 per month, but she starts saving earlier from age 21. Instead of saving until the age of 65 like Jack, Beth only saves for a 10-year period up until age 30. She then stops saving completely and lets the power of compound growth work for her. By the time Beth reaches age 65 and assuming the same 9% rate of return, she would have around $1 million. So despite the fact that Beth only saved for 10 years, in contrast to Jack, who saved for 35 years, Beth had substantially more money at retirement. Now, if Beth didn't stop investing at 30, but instead continued investing up until age 65, she'd have close to $2 million saved. These simple examples clearly demonstrate the incredible power of compound growth. Think about your investment journey as being a snowball rolling down a hill. It starts off small and slow, but quickly gains size and momentum as compounding starts to take effect. The sooner you can start investing and the longer you can stay invested, the more your money will work for you.
Let's now quickly discuss the impact that brokerage fees have on our investment returns. When we invest in a mutual fund, for example, the fund manager will take their fee for their services. Whilst it's obvious that the less we can pay in fees, the more we will benefit, just how significant is this exactly? Let's look at a simple example. Assume we have $10,000 which we invest for a period of 30 years. We get an average return of 9% per year. Without any annual brokerage fees, we will have $132,000 after 30 years. But what happens if we introduce just a 2% fee? 2% doesn't seem like much after all. Well, the result may surprise you. With a 2% annual fee charged, our lump sum after 30 years is reduced to only $76,000. That's a 40% reduction in money just from a 2% fee, and that's pretty dramatic by any standard. So never underestimate the impact that even a small fee can have on your investment performance over the long run. And always take into account investment fees when evaluating your investment options.
This concludes part 1 of our Beginner's Guide to Investing series. Thanks so much for watching. In part 2, we cover everything from what you should consider before investing, to the best way to invest, to unpacking some powerful alternative asset classes. See you in the next one.